Building wealth in the stock market is not about you picking the winning stocks. It is about you building a healthy portfolio, which is going to assist you ensure you mitigate risks, is going to assist you preserve your capital, and hopefully is going to assist you enjoy share price appreciation or capital gains, and as an extra also possibly get dividends. That is why in this video I want to discuss 10 common mistakes which investors typically do as they are building their portfolio or even managing their portfolio in the stock market. And this is an important video for you because you need to watch the whole of it for you to understand these mistakes and also avoid these mistakes. And by the way, I did write an ebook about how to build a portfolio in an appropriate way and also how to review a portfolio to ensure you are investing appropriately in the stock market. In case you are interested in that particular ebook, I've attached a link down below in the description and also the comment section. Go and check it out. It has all this information provided comprehensively, and also I've drafted tools for you which can assist you track your performance in the stock market. In case you are new here, my name is Apagza Sifuna. I am a finance expert and qualified accountant, bringing you amazing videos about investing and making money each and every day. In case these are kind of topics which you like, down there is a button called subscribe. Click the button for you to subscribe to my channel so that you don't miss the videos I do upload each and every day. And I will still add it. Drop a like on this video. Thank you for subscribing and also liking this video. Having said that, let's jump right in it. And the very first mistake which a number of investors do is that they do put too much money on one stock. Of course, we all have our favorite stocks out here. Fair enough. But then again, building a portfolio is not about you just adding your favorite stock or continuing to buy your favorite stock in a portfolio. You are looking to build a right or healthy portfolio. So in case you have too much money in one particular stock, that is going to cause something called concentration in your portfolio. Simply put, the majority of your investment or concentration in your portfolio is going to be on one stock. In case something happens to that particular stock, it's going to mean you're going to really have bad loss because the effect of that particular weight in the portfolio is going to affect your average returns. And the second mistake, which a chunk of investors out there do, is that they fail to diversify. Diversification is not just you holding a ton of stocks. It is you being very deliberate about how you are constituting your portfolio. Diversification needs to entail you getting stocks from different sectors. Okay? It needs to entail you getting stocks from different sizes of companies. Is it large cap, mid cap, or even small size companies? It also entails you being very deliberate to mix different kind of investment. Is it defensive business model, or even is it cyclical business model? You need to have a mix of all this in your portfolio for you to really diversify optimally. Diversify against company size, diversify against sector, and diversify against investment style or technique. That way, you'll have an optimally diversified portfolio. And then the third mistake which investors out there do is that they do buy without doing valuation. What is valuation? Valuation is whereby you really compute to really understand if a stock or share in a given market is overvalued or undervalued. In case you just buy without valuation, it's going to simply mean you might end up purchasing a ton of overvalued stocks, which after some time, once the intrinsic value hits the market, these stocks are going to see their prices come down. That is why before you add any stock to your portfolio, ensure you do valuation. Not because valuation is an exciting thing to do. It is a simple thing to do, yes. It might be boring, but it's very simple. Through different measures out there, for example, the PE ratio, the book value ratio, you can be able to see if a stock is overvalued or undervalued. And then you can compare that with the specific sectors to really see where a given stock stands before you make any decision relating to you purchasing or adding anything or even removing anything from your portfolio. And then the fourth mistake which investors out there do is chasing high dividends. Guys, just because a company didn't pay dividend last time, it doesn't mean they're going to pay dividend again. And I'm saying so because dividends are typically paid at the discretion of the company's board of directors. And beyond that, you need to do some simple calculations for you to really understand if even there's a future potential of a company paying you dividends, right? Understand the dividend yield, understand the dividend payout ratio for you to be able to even know if the payout ratio is sustainable or healthy before you jump on any particular stock. And even assuming all these factors are ideal, you shouldn't just jump, for example, in purchasing those stocks which are paying high dividends. What if all those companies are coming from one sector? Does it mean you're only going to hold stocks from a particular sector? That will mean you're not diversifying. That is why dividend payout potential needs to be just one of the things you are looking at. Don't chase dividend stocks because that's your only point you are looking at as you are building a portfolio. Look at it comprehensively. And then the fifth mistake which investors out there do is they never review their portfolio. Guys, it is one thing to build a portfolio. It is another thing for you to review a portfolio according to the appropriate structure. That is why you need to be reviewing your portfolio according to the recommended times so that you ensure at all times you are very aware of what is happening in your portfolio, you are aware of the stock sizing, and most importantly, you are maintaining a healthy portfolio. That is why you need to have a standing cadence of you being able to review your portfolio. And by the way, in the ebook which I wrote, I've really explained in details how you go about reviewing a portfolio, what you look at, and even so, how you change different positions. So grab a book as it's still outlined. The link is down below for you to be able to really understand and implement the ideal approaches for you to be able to review your stock portfolio. And then the sixth mistake which investors do is that they do invest without clear investment goal. In case you don't have a goal, where are you going to? Right? At the end of the day, investing is a journey. You are starting somewhere, you are aiming to go somewhere. In case you don't have an investment goal, you don't have an investment thesis, what are you looking at? Because it's going to be a very big mistake for you to invest without a goal. It's going to mean you'll be walking in darkness. And if you're walking in darkness, anything goes. You're going to grapple on anything you can hold on to because you won't know where you are going to. As a starting point, have a clear goal and then build your investment around a particular goal because you are working towards a given goal. And then the seventh mistake which investors out there do is ignoring risk mitigation. Guys, risk management is one of the key things when it comes to building a healthy portfolio. In case you are just chasing returns, you are focused on returns, you are focused on dividends, you might end up ignoring risk management. And then the truth is that in any stock market out there, your number one priority should be capital preservation. Simply put, ensuring your capital is intact, and then you can be able to gain something. In case you're just chasing returns, you might end up risking your capital and even end up missing the returns which you are chasing. That is why prioritize on preserving your capital through building a healthy portfolio which mitigates risk, and then you will be able to gain naturally over time. And then the eighth mistake which investors out there do is that they let emotions make decisions for them. One of the biggest mistakes you can do as an investor is letting emotions decide for you. In case you are investing based on emotions, each and every day in the market, when you look at the prices, it's going to evoke excitement, it's going to evoke fear. Depending, whichever of these emotions is not good for you to based on as you are making a decision. Because at all times, you need to make decisions based on fundamentals, based on your analysis. So in case you let emotions decide how you are investing, at the end, you'll end up losing. Because due to fear, you might panic and sell. Due to excitement, you might panic, you might jump and buy, and yet you are not looking at the health of your portfolio. So be objective, be disciplined. Don't let emotions drive your decisions in the market. And then the ninth mistake, which investors, most of those beginning investors do make, is holding too many stocks. Guys, a portfolio and diversification is not holding too many stocks. It is holding the number of stocks which are comfortable to hold, and you know what exactly is happening or why each of those stocks is in your portfolio. Just because you are holding 30 stocks, it doesn't mean you've diversified. Go and do proper diversification and build your portfolio deliberately. A portfolio is designed, it's not built by accident. Just because you have very many stocks, most of you are beginning out, it doesn't mean you are doing well. Because you might have many stocks and that you haven't diversified, okay? And then the 10th mistake which investors out there do is they don't track performance of their portfolio. Tracking performance of a portfolio is very important because you're going to objectively ask yourself some questions. Why are you buying a given stock? Why are you adding it to your portfolio? What lessons have you learned with every change you made to your portfolio? What lessons can you carry forward? All these In case you are tracking in a structured way, you're going to be able to learn lessons along the way, implement the good lessons, and most importantly, continue building a healthy portfolio. So you as an investor, ensure you are tracking your portfolio optimally, knowing very well each of the position you have in your portfolio, each of the value, how they have changed month on month or even quarter on quarter. And then at the end, you're going to be able to continue building a healthy portfolio because simply put, you cannot manage what you can't measure. So ensure you track your performance of your portfolio for you to be able to make more informed financial decisions. Guys, what do you think about these mistakes? Have you made any of these mistakes? In case there are other techniques out there which I haven't spoken about, share with us down below in the comment section. Comment down there. Let's continue discussing. Cheers, guys, and look forward to catching up with you in the next videos.